You are listening to the Will Power Podcast. Welcome to the show. I am Will Holdren, and I talk with some of the most influential CEOs, entrepreneurial leaders, and thought leaders to reveal the secrets that have led to their success. I believe that with the right knowledge and mindset, you can do anything you say your mind to. So if you want to learn how to change your life for the better, if you want to learn how millionaires actually became wealthy, or if you want to develop and start your own business from the ground up with the right knowledge to help you, then you are in the right place because this is the Willpower Podcast. What's up, everyone? We are back on this following Wednesday going over your guys' own questions in our follow-up Q&A episode with me personally answering your guys' questions. Once again, you can submit your questions by sending them to the email address at the bottom of all these recent episodes. They'll come to our inbox. Our team will look at them, evaluate them, and then if you get chosen, we'll start answering your guys' questions on the next week's Q&A episode. So today, we want to jump right into this one. We got some great questions coming in. Just at a first glance, looks like we got a lot of people from Atlanta sending their questions in, so that's fantastic. Once again, I'm actually based out of Atlanta. So we'll jump right into this one. So we got Chris from Atlanta, Georgia. And he said, what is the smartest financial move you made early in your career that helped you build wealth faster? So for this question, I would say the best financial smartest move I made was something that I did that wasn't really for the money, right? I said this again last week, but the smartest move I think I personally made was starting up my own podcast. And again, going into that, my whole idea was building up connections and building up my network and building up relationships, because if you have these really high performers, these really top-notch entrepreneurs in your network, you have really good connections around you. When you have that business idea down the road, those are the people you can then approach, and they can help you fund that first idea and help you get that business idea off the ground. And it can turn into a lot of money, right? Because you have a really good connection. You nurture that connection, you nurture that relationship, and who knows down the road what that can turn into. But, I've tried to do a lot of business over the years. Some of them worked, some of them didn't work. But the ones that really were successful are the ones that I wasn't focused on the money, right? I was focused on making an impact. And the podcast was one of those first opportunities I had. And it turned out to be my best financial move. Every opportunity I have had recently has honestly come from the podcast, right? It's come from people that I've met through my podcast. And again, I always encourage you to go out there and build your network, because your network is ultimately going to be your net worth. So the next great question we have here is actually from Donna out of Maryland. And she asked, how do you possibly keep up your energy by doing a podcast, working in a job, doing real estate, and so many other things in your everyday life? And that is actually a fantastic question. As I talked about previously last week, it's all about time management. It really is. And being in charge of your calendar and understanding what takes priority in your every single day life. But even with that said, I mean, it's very important to have energy. It's important to feel good during the day. It's important to stay healthy, make sure your body's in good shape. And one of the ways that I do that actually is something called Magic Mind. And this is an energy shot. I mean, that's really the best way to put it. It's amazing because it's a mental performance shot. And you can really take it, with your normal morning daily routine. If that's what you do, take it in the morning, take it at night. And it really helps you stay focused, mentally clear. And I've been taking it for a while now. And in fact, they reached out to me beforehand, and they actually sent me a few of these Magic Mind shots to take. And I've been taking it for a while now. And I can't tell you how great I felt. And it really has helped me go out during the day and just stay on top of all of my tasks and be productive and be focused and have that mental clarity that I really need. And it's really a fantastic thing to get involved in your everyday life. If you guys are looking for something like this that's healthy, I can actually help you guys out. You can get a 48% discount off your first subscription, or you can get 20% off one-time purchase with a code that will actually put into the link of this episode. But again, that code is going to be https://www.magicmind.com/WPLT20. And again, use the code WPLT20 at checkout. Get a 48% off your first subscription, or like I mentioned before, 20% off your one-time purchases. with that code. I think you guys will really enjoy it. It's just a really healthy way to stay on top of your day and stay focused. And again, I've been using it for a while now. I love it, and it helps me get through each and every day and just be productive when I need to be productive. So it's a great thing to get involved with. They've done over 200 scientific studies on this drink behind every ingredient. It's all fantastic. It's all positive. It's all very healthy. Go check it out and link in this episode. And let me know how that works for you guys. Again, we're all about supporting one another and helping each other become the best version of ourselves each and every day. So that is one way that I keep my energy during the day and help stay focused. The next question we have here is Rachel from Miami, Florida. And she said, how did you fund your first real estate deal, and what advice do you have for someone with limited capital? So for those of you that know real estate, you know that it takes a lot of capital just to get involved, especially if you want to become an investor. So one, either you need to have that capital to get into a deal, or two, you can partner up with someone who has that capital. So for those of you guys that have been following me, you'll know that I partnered up with someone that I met, and they helped me fund that first real estate deal, even though I had limited capital. Now, for some of you that might not be easy to go out there and pitch an investor or find something to go out there and raise money. One way I would encourage you just to get around real estate, right, and actually save up some money to get into a deal is one, you can get your real estate license. If you're a realtor, you can get big pops of income. You go out there and sell a house, you get a 3% commission. Right there, it could be 8 to 10 grand, right? You only really need a couple of those a year, and then you can go out there and really just fund your first deal. And also, you're going to understand the process of real estate when you have your real estate license, because you're going to be around real estate. You're going to know how a deal works. You're going to know how to fund a contract, write a contract, how to analyze properties, right? And so it's a really great way to get yourself started and just learn the background of real estate. Now, for those of you that don't want to get a real estate license, another thing that you could do in order to help fund your first deal is to look into wholesaling. And wholesaling is a really unique example of where you actually don't need the capital, right? But you're acting as a middleman, where you're actually going out there, finding those deals, making an agreement with the seller, and then once you have those deals, you're actually going to flip those deals and resell that deal to a buyer, right? And then you're going to get the middle ground of how much the difference between what you got the deal for from the seller and what you sold the deal to for the new buyer. And again, it's a really great way to get your first foot into real estate and get a couple big pops of income out of the gate, which can really help you down the road. So that's how I would encourage you to get started if you have limited capital. And again, one of the misconceptions is that you need a ton of money for a down payment. And really, it depends on what kind of property you want to do. I mean, sometimes we talk about house hacking, right? House hacking is a great way where you personally can buy property. There's loan programs out there called FHA. You can get a Fannie Mae or Freddie Mac loan where it's really only going to be about 3% down of the purchase price. And you have to come up with that kind of money. And even in some situations, I've seen it where the government will have a grant. Well, they cover 2% of that 3%. So now you only need 1% down. Now, again, you might have some rehab costs, so you got to make sure you take all these additional costs into mind. But just for the down payment, I mean, really, I think once you get around 10 grand for a personal property, depending on how much you want to spend, I think that's a really excellent way to just get started right away. Now, if you're talking about investment property, typically you're going to want to have about 20 to 25% down. And the reason that is because the lenders don't want to give you a lower down payment option for those, because it's not your primary residence, meaning you're not going to take care of it as well as if you would if it was your own personal property. So you got to keep that in mind. So again, once you do an investment property where you technically don't live there, you're going to have a higher down payment requirement. So good question there. The next one we have Jake from Phoenix, Arizona. And he said, what percentage of your income do you reinvest into new business opportunities or real estate? So this is a very interesting question. So honestly, it depends where you are in life, but I would highly recommend it, most of your income that comes in, if you don't need it for living expenses, I would definitely focus on having a nest egg, right? For the what if scenarios where you can cover a couple months expenses if you had to out of the gate. And once you have that saved up and that good to go, I'd recommend really saving all money and trying to get into real estate in one way or another. I mean, real estate is one of the best assets you can possibly get into. I mean, real estate has outperformed the stock market historically over time, and it also outpaces inflation. And with real estate, not only are you going to get appreciation where the property just goes up in value pretty much every single year, again, depending on what the market does, but historically it's gone up over time, right? It's appreciation. There's only so much land out there, right? And the population's growing every single year. So real estate's not going to be an asset class that's just going to go away magically. And another thing that I love about real estate is that it's a physical asset, right? I mean, if you go out there and invest in stocks, I think that's great, but you really don't have control and no one really has a crystal ball of what that stock is going to do going into the future. With the real estate, I like that you can control it, right? It's your money, you get a physical asset, you can see what it looks like, you can touch it. And on top of all that, you're going to get depreciation, right? Once you guys start paying taxes, you can take depreciation off of your property over a couple of years, and that depreciation can actually offset your taxable income. So it's a great tax shelter as well. But like I mentioned, I definitely recommend putting most of your income that you don't need to live and you don't need to save into a real estate savings, right? Go out there, you can find a high yield savings account. You can go online, find something called Betterment, for instance. It's a great way for you to, have a savings that's going to give you more of a return than a typical bank account would, right? A bank is what going to give you 0.1%, and ultimately that's not a great option. But if you can find these high yield savings account, like I mentioned, like Betterment, they'll give you market rate return, right? So right now you could probably get about 3.5% return on your cash, which is awesome. And you can go forward and it's a good way to save money. And eventually, once you have enough for a down payment, then you can jump right into it. And again, another thing too, for those of you that are listening, I mean, if you're younger and you have, for instance, no family, no kids, I mean, now is the time to take that risk in your life, right? Take that jump, because when you go forward, it's only going to get busier and busier and busier, and things are going to get pushed to the back burner. So now is the time to really go out there and take that risk while you can, and take that jump, right? It's going to be a little scary jumping into it, but once you open up that door, get that first one done, you're going to feel great. And if it works out, it's even better, right? But on top of that, you're going to get an excellent learning experience. The next question we have here is Daniel from Atlanta, Georgia as well. And he asked, how do you determine if a business investment is worth the risk, and what financial metrics do you consider first? So this is a loaded question here. If we're talking specifically about real estate, you definitely want to know your numbers, and you definitely want to understand what your strategy is and what your long-term goals are. I mean, a lot of people want to get the best of both worlds, where, for instance, you're going to get high appreciation and you're also going to get high cash flow every single month from a real estate property. Now, that may be great, but you're going to be very limited on spots you can jump into that are going to have both of those situations, both of those combos. So for me in particular, the long-term appreciation was much more important to me than the early on cash flow. Yes, you want the property to cash flow, and of course you do, because you don't want to lose money, but you don't need it to cash flow extra much. What's important is that you get that appreciation where you're in an area, perhaps a transitional neighborhood, right? Somewhere where it's developed in some spots, not developed in some spots. You can see the neighborhood kind of transitioning. And that's really where we're going to get the most appreciation, that more value. And for instance, if you can find those transitional neighborhoods that can cash flow even, then that's fantastic. So again, that's how I kind of determine if the real estate that I'm investing in is going to be worth the risk. I want to make sure that it's in a high appreciation neighborhood. You can find that out by going to certain websites and finding out what the average appreciation is, and also go drive around in the neighborhood and see what's going on around there. So that's definitely important. And then the next question he asks is, what financial metrics do you consider first? So again, this is also a really important question, especially you guys in real estate. You need to understand how to evaluate the deal and what you're actually looking for in a deal. So some important metrics that I use when evaluating a property is, the first one is called the annual return on cost. And this is an important number. And how you get this number is you take the net operating income, and how you get net operating income is you find your total revenue, subtracting all of your operational expenses, and that's going to get your net operating income. Again, for net operating income, you're not going to take out your debt service. So you're going to have your revenue, your expenses, for instance, contractor maintenance, you're going to have taxes, you're going to have insurance, pest control, whatever that looks like, electric. Subtract all out those operating expenses, and that's going to get you your net operating income. And then that's the number you want to use in this formula. So again, it's net operating income divided by purchase price plus your rehab cost, so your total cost of getting into a property. And this is going to get you your annual return on cost. For this one, I like to see an annual return on cost that is double digits, and that is typically around 12 to 13%. And again, this is going to help you understand how much return you are going to be getting. Um, and like I mentioned, it's important to understand this, because it's ultimately going to tell you the profitability of this project at the end of the day. So that's important one, and an important one to run. Again, you guys can Google that one and learn more about that one. The next one I like to use is a cash on cash return. And so this one, for cash on cash return, the formula is cash flow before tax divided by the down payment plus closing costs plus rehab. So ultimately, the total cost of getting into the property, not including the purchase price. Now, the cash flow before tax, again, we found out what NOI was. Once you have that NOI number, then you're going to subtract out your debt payments. So if you have any interest payments, if you have a mortgage, you're going to take all of that stuff out, and then you're going to take that number, and that's going to be your cash flow before tax. So again, it's NOI minus debt service. That's going to get you your cash flow before tax number. And